and welcome to this week's Market Outlook webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held on the 7th of June at 12:30 in the afternoon. This is a webinar due every week on a Wednesday lunchtime, and it's a mix of looking at a bit of a market outlook, levels to watch, and also a session on strategy. And today we'll talk about when's the right time to move your stop loss to break even. So we'll spend a bit of time talking about that and some ideas on what you might want to do with that. I'll be using Aondo's trading platform throughout this. Aondo are maybe better known for social trading, for where you can copy other traders, but you can trade for yourself as well. But to find out more about the social trading aspect, I've been blogging about a real live account with a couple of thousand quid in it, and you can read about that on tradeafter.com. Just put the risk warning up there so people can read it. Clearly today's the last day before the UK goes to the polls. I'm sure we'd all love an extra 4 weeks of electioneering from here, but tomorrow we go to vote. We've seen a bit of volatility in those polls. It's going to be an interesting outcome, I think, for the UK general election. Tories still the favourites to win it, although we have seen their lead eaten into over the last couple of weeks. And if we get any shock results, that's clearly going to have an impact on markets, particularly the pound. So we'll spend a bit of time looking at that. Just a quick word from our sponsors from Aondo, and they've got a deal on at the moment. If you deposit €3,000 or the equivalent in proper money up until the 7th of July 2017 in your account, you get access to this 3 markets signal service free of charge, which would normally cost you €600. You get that for 6 months. So it's chart-based trading signals, daily trades, quick position management. So if you go to aondo.com/en/3 markets, you can find out more about that offer they've got on at the moment. But let's take a look. Let's have a look at what is going on. So we're using Aondo's trading platform, Trade Hub here. So we're gonna we'll start off, I think, with pound against the US dollar. I think this is going to be pound against the dollar. Euro sterling is going to be the big one to watch over the election. And it's really, I think, on the downside, there's the big level from last week that I was talking about, where we've seen the market has had a fair bit of support just below where we are now, around about the 128 mark. Let me just take that out. We were looking at this a week ago. Here we go. So it was after this surge. I think the surge that we had during April, pound against the dollar, was off the back of Theresa May actually calling the election. So they saw it as a positive for the pound. We saw the market move sharply higher, go sideways for a few days, then push out briefly above 130. And if you remember from last week's webinar, we were around about here, this sort of area here. Actually, let's chuck a squiggle on there, because I know a few people like the old squiggly lines. Let's chuck our RSI on there. There we go. So we had it was a good signal. It was a good setup last week. Let me just draw our line on. Which line do I want? I want the horizontal high-low. So let's put that in there. There we go. So we'd had, after the surge when the election was called, we had a bit of a wobble around for a few days, but there seemed to be an appetite to be a buyer of pound against the dollar ahead of the 127.50 level. The market then ran up nearly 300 points, up above 130, came back down to it last week, dipped below 128, buyers came back in, came back down to it again last week, poked a little bit lower, setting up this bullish divergence that we've talked about before, where the market hits a level, pushes a bit lower, but the RSI in this example was trending higher. So actually that's a 14-day RSI. Let me change it to my personal favorite, or a 10 RSI. There we go. We've still got the divergence. So bullish divergence, suggesting that maybe this weakness was running out of steam. And since then, we've seen the market move up about 100 points or so, 150 points at its best. So this 127.50 level, it's clearly, I think, an important one to watch. If we do see maybe some surprising results coming in, so I think maybe the bigger risk for sterling is the threat of a hung parliament. If we have no overall winner at the end, you think that could put a bit of a dent in sterling. Saying that, markets have over the last year or so, particularly with the presidential election, performed opposite to what people were expecting. But I think if we did see weakness when results start coming in, or on Friday, then this 127.50 is a big level to watch. If you see it, pushed back in a move to there and hold, it looks like another buying opportunity. But I think that's the big one to watch. We've been holding above this level for a good 5 or 6 weeks now. So I think that's really an interesting one to watch. On the upside, the obvious one is up here. 130, what's that? Well, let's say 130.50. Let's round it up. So I think 127.50 on the downside, 130.50 on the upside. These are the ones to watch. But I think, like we saw on Brexit night, if you were up watching the results through the night on the referendum night, incredibly volatile pound against the dollar. Not surprisingly, the brokers knocked the spreads out. I think it's hard to trade it if it starts moving like that. Personally, I'd maybe rather wait for the dust to settle, come back to it next week and see where we are. But those are the levels to watch, and that hasn't changed over recent weeks. We've got this clear band of support for pound against the dollar. We're currently, pretty much slap bang in the middle of it. Let's see what happens in the early hours of Friday and during Friday. The other one, of course, is the FTSE 100. The FTSE, a weak pound, as we have all learned over the last 12 months or so, is good for the FTSE. If the pound does weaken because so many FTSE 100 companies make their money internationally, then when they repatriate that money and book it back in sterling, a weaker pound is good for them. So a weak pound should push the FTSE higher. But we have seen, fresh all-time highs yet again for the FTSE. It's come off over the last couple of days. But again, it's brought us back to a level that has been, I think, an interesting one. So if you were really convinced from here the FTSE was going to go up and you didn't care too much about the election, we've got some these big levels just below 7,500 that have been providing support for the FTSE. We've seen it on the sort of pushes out higher, comes back off to 73.90, then it's pushed its way higher, but whenever it's dipped below 7,500, it hasn't stayed there for very long. So I think it's interesting with the market trading currently 75.08 to buy. You can see in the last hour we've had a bit of a reversal in the last hour. But I think if you were watching the FTSE this afternoon, let's maybe flip it over to a bit of a shorter term chart. It'd be interesting to see how it performs down these levels. You can see these are 30-minute candles. You can just see how many attempts have been made to push below 7,500, but they haven't lasted. So I think that's an interesting one to watch. But again, we'd expect FTSE volatility maybe on Friday once the election result comes in. Assuming the Conservatives do win, you'd expect business as usual, really. I think for the stock market and for the pound. But we'll see. Let's wait and see what Friday brings. Okay, so there's the two markets to watch. The FTSE looks like a potential buy down here. I suppose if you could wait and see what happens. If it dips below 75, you might want something of a wider stop. The other side of this low here from May the 24th, the other side of maybe 74.70, looking for a rotation back up to 7,600. But I think that's maybe one to watch the next couple of days. We'll look at US stock markets today. We did see last week the S&P 500 and the Dow finally moved out to fresh all-time highs as well. But it's been in a bit of a drift mode this week. So clearly a lot of the FTSE's direction is going to be dictated by that, but we'll take a look at these US stock markets in a sec. But first of all, let's do our little strategy talk thing. So I'm just going to flip this over to here and bring up the thing that lets me scribble on the screen. There we go. There we go. Right, so hopefully you can see like a clean sheet of paper here. So let's talk about moving stop losses, because I don't think it's a secret, that when it comes to short-term trading, most people lose. That's not a heavily guarded secret. And there's something I put on my website years ago. There was research done by a foreign exchange broker of 12 million trades that their clients had done. And it came out that people were actually pretty good at forecasting direction. Most trades made a profit, so more than 50% of FX trades made a profit. But where it went wrong was if the average profit was 100 quid, the average loss was almost 200 quid. So it's the classic wrong psychology that people do of letting losses run and snatching at profits. So I thought, let's see if we could deal with at least part of this today. Let's say we've got a market that's been trending lower and has done that. Okay, so you think, okay, the market's hit support, and to make the numbers easy for me, let's say that level is 110, and let's say, so I'm going to put my stop at 100, and I'm going to buy in at 120. So I've got some obvious levels to keep an eye on, and I think the temptation is, and let's say we think the market is going to go back to 160, so plucking numbers out of the air. Actually, no, we'll say 180 because that makes it a 3-to-1 trade. So we've got 60 points upside and 20 points risk to the downside. But I think the mistake that many people make is if a market moves to 130, so you're in, you bought here, and the market moves up to 130, people get euphoric that they've got 10 points of profit. I think this is fantastic. My trade is finally making a profit. I've got to do what I can to make sure that the evil market doesn't take my trades, my profit away from me. So straight away we're into the mentality of snatching at profit. So I think it's far too tempting as soon as a trade is showing, just a modicum of profit, to move the stop loss to break even. So they might say, right, I'm going to put my stop loss at 120. I've got a free trade now. Isn't that fantastic? Well, no, it's not really, because the market's only moved 10 points in your favor, first of all. 10 points in this example here is not that much. When you put the trade on, you are happy to risk losing 100 points. So straight away, you've eliminated the risk, which gives you a nice warm feeling. But the chances are the market will just do that. We'll wiggle back, take you out of break even, you're out of the trade, and then what if your initial analysis was correct and the market carries on the way you thought it was going to go? So I think that the point I'm trying to get across here is don't be too quick to move your stop loss. And this does need a bit of thought. I think the actual mechanics of trading are easy, maybe too easy. You can just log on, put some money in your account, click, bang, you're in. But you just need to give a little bit more thought to it, because so for me, one idea I would suggest, so something I do, is I want the market to move at the very least in my favor the distance my stop was away. So in this example, if my stop is 20 points away, if I'm happy to risk 20, then I should be waiting for the market to move at least 20 in my favor before I move my stop. It's not perfect, but I think it's better than moving your stop to break even as soon as you're showing a bit of profit. So for me, the market's got to move to 140 in this example before I move my stop to break even. And I'd suggest if the market has moved that much in your favor, a bit more in your favor, then you are at least on the right side of the trend. And I would say, from maybe an experience and maybe a bit finger in the air and a bit experience, at least the market is traveling the right way. So the chances are, on balance, because the trend is going the right way, the next 20-point move should be in that direction rather back in that direction to take you at break even. And then, of course, if it does start moving further and further in your favor, it's all about trailing your stop up behind it. But I think it's important. Nobody likes losing trades, but losing trades are a fact of life. But don't be like these people in this study that you can read on my website, where that they'd make 100 quid, but they'd lose 200 quid, because they're snatching at profits too early, too quickly, and letting the market go too much against them. So give some thought to, okay, if this turns out to start going my way, what do I want to do with my stop loss? And I'd suggest, for me, I want to see it move at least the same distance. Maybe you'll have a different approach. Maybe you want to see it move 1.5 times the distance. So in this example, you want it to move 30 points in your favor, whatever it is. But I'd say it does need a little bit of thought. It's not rocket science, but don't be in a hurry to move your stop loss too quickly just because you've got a profit there. There we go. There's our little strategy thing, which we will expand on that in the next couple of weeks. Let's go back to the markets. Let's go back and onto here. So we were looking at FTSE and the pound against the dollar. Well, the FTSE's already up about 5 points. Should have bought it. So clearly wants to watch over the election. Let's take the election out of the equation for a bit. Let's go and look at, I think, a couple of other interesting markets. For a change, let's do oil. I've mentioned in the past I'm not a big fan of oil because I could never get it right, basically. So I don't really trade it hardly ever. But I think it's interesting what's happened over the last few days in oil. So my view on oil, if we take it back to maybe a longer term view. You know, we had that big crash last year where it traded down to $26 a barrel. Then we saw a recovery for much of last year when the world and his wife was bearish of oil. Of course, what does the market do? Completely the opposite. So we saw the market really recover. Finished last year sort of punching through the 50 level, but I thought we'd see much more progress this year, but we haven't. It's really struggled this year. But for me, as long as these lows remain intact, sort of 39 to 42, that trend is still up. So my bias is still for higher prices in oil this year, but it's not happening at the moment. But I thought it was interesting what we'd seen over the last few days. So this is an hourly chart we're looking at. So we saw it hit 52 the other week. Was that last week probably? Yeah. So we saw it hit 52. And then it's come off really sharply. But once again, I think what's happened over the last couple of days is interesting. I think in webinars in the past, I've mentioned, you know, the importance of the previous day's high and low. You know, for short-term traders, if a market slips below the previous day low, well, clearly there was a level yesterday where the market saw value. It's not there anymore. But on June the 5th, so earlier this week, the price of oil punched up through the previous day's high. Okay, so that was the high from the day before, punched up above it. So it did show some strength in there, pushing up to 48.40. Then over the last couple of days, it has come back down to those old lows, but the positive here is it hasn't broken those old lows. So let's chuck our line in there. So I think this is the big level to watch, I think, for the shorter term oil traders. So it came back on June the 5th, which was Monday, and then it came back again very early hours of June the 6th, and it's managed to bounce up. So for me, it looks like this week we've formed, you know, something of a line in the sand. You can see the level, $46.75. It's currently trading at $47.92. So I think for those who are fans of oil and maybe like these more volatile markets, if we did see the price of oil sell off, you know, back down towards the low 47s, it looks like maybe, you know, a buying opportunity. Maybe this slide is over, famous last words in oil. The shorter term slide anyway is over in oil, and we'll build a base here for another go at the 50 plus sort of region. So I think oil is an interesting one to keep an eye on, although I will not be trading it probably because I never get it right. Saying all that, it's going to crash now, isn't it? It'll be $40 this time next week. One market that has been moving, I think as expected, is the price of gold. We have seen gold not quite push out to fresh highs for the year, but for me, I think we were talking about this last week, you know, it has confirmed that trend is still intact, even though if we drew a trend line off the lows, let me just get our high-low line in. So off these lows, these December lows, that trend line has broken, but for me, because it didn't break the previous major support ahead of sort of $11.95, the trend is still intact. You know, maybe it's just going to go up a bit slower, and that is what has turned out, how it's turned out lately. So if we still haven't quite, well, we had a little look through it yesterday, $12.95 an ounce. It's maybe a bit overbought on the RSI down here, and the RSI has done a not bad job of calling the tops in gold, the short-term tops in gold this year. So I think maybe it's a little bit overextended. But for me, it does confirm that the strength is still out there for the price of gold. So I think even if we did see a sell-off over the next couple of days or the next week or so, I think there are some interesting levels to watch to see if the price snaps back again. The big level is back down here from the lows from earlier in May, around about 12.16. But for maybe the shorter-term traders, you can see how much it's accelerated. Maybe, you know, if we got back this clear support back here at 12.60, about $30 below where we are now, a bit further out ahead of 12.50. So I think for me, I'd still be inclined to watch, even if it sells off hard, watch for the buyers to come back in and look for another go to see if it can crack that $1,300 an ounce mark. So I think there's oil and gold, a couple of interesting markets I think to keep an eye on for different reasons. Gold is maybe more of a relaxed one, just to see how the next few days pan out. If it sells off, do we see the buyers come back in? But oil, because I think we have over the last few days formed that base over the lows of the last few days, that if it sells off back to 47, it looks like a good opportunity for maybe a bounce. Let's take a look at some of the stock markets, and then we are going to take a look at some currencies. We're going to take, we've looked at the pound against the dollar. I'm going to look at dollar Canada in a sec because I think there's maybe an opportunity there. But let's take a look at stock markets first of all. Well, we had it on the Dow, finally on the Dow last week. I think it was Friday or maybe it was Thursday. But it managed to break, and maybe in the out of hours markets it was breaking out. But we had these old highs that were set late Feb, early March, and it just couldn't get through. Couldn't get through. 21,170, I think, was the level. But we did see that broken last week. But since then, we haven't seen much in the way of progress, and we've seen a bit of a drift. We'll look at the S&P in a minute. I think the S&P is a more representative market. But here we go. So this is the Dow on the hourly chart. That was the surge that finally took it out to fresh all-time highs, but little follow through since then. Saying all that, you know, we have seen, again, for the short-term traders, I think that was it the day before yesterday, we had the narrowest range in the S&P for something like 20 odd years. It was a really, really quiet day. So we haven't seen the same sort of exuberance that we had last week flowing over to this week so far. So I think for the Dow traders, the bias is still up. Don't get me wrong. I think you know, the weakness. If we saw any significant weakness in stock markets, like we did, which is just a blip now from a few weeks back, you know, it's still. Oh, sorry, it was here. You know, it still looks like it's still a buying opportunity. So I'm sure that, you know, if you looked at sentiment amongst retail traders, I bet most of them are short at the moment. But you know, the reality is it's a market that's still got a very bullish bias. So I think, you know, if we saw the Dow drop back towards, I think, the 21,000 area, so it's only 150 points from where we are now. You know, it looks like a buying opportunity based off this support here towards the end of last week. For the really short-term traders going into today, you know, where are we? So the lows from yesterday, the sort of in-hours lows were down here. So that is, what's that sort of level? 21,110, that sort of area. So that was set right on the open yesterday. So it ended up being a bit of a bullish, well, mildly bullish day yesterday. It set the low on the open at 2:30 UK time, traded as low as 21,117. So I'd suggest if you're a fan of sitting there and clicking away and trading, that's the level to watch for this afternoon on the Dow. If we do see it sell off, and it's only 30 points above it now. If the market sells off, let's see how it performs down here. But if it breaks, you know, I think that we're going to see maybe a bit more drift. You know, I don't think we're going to see like a crash, a massive sell-off, but we'll see a bit of a drift. But I think there's a clear level to watch. But it's definitely been a little bit lackluster in the last couple of days, despite setting all-time highs, finally setting all-time highs last week. Let's look at the S&P 500, so the broader US stock market. Now that had been setting all-time highs much before the Dow. But again, it was a similar sort of pattern. It sort of scrape out almost reluctantly to all-time highs, then sell off, and then scrape out again, then sell off, and then we saw it again last week. But again this week, the pattern, I mean, it is looking pretty overbought up here, but in a strong trending market, as we saw back here in February, just because the RSI goes overbought doesn't mean the market isn't going to carry on running away. So it is overbought, but I don't think that means too much at the moment. But again, like the Dow, it's been a little bit drifty, I think, so far this week. This is an hourly chart of the S&P. Big level to watch down here. The lows, the out-of-hour lows yesterday, about 24.27. Also, the out-of-hour lows from end of last week. So I suggest a big level to watch. The lows from yesterday were in, hang on, where are the lows from yesterday? It's here, isn't it? Yeah, here. Oh, 24.27.5. So this 24.27 to 24.27.5 level is a big one to watch for short-term traders. But it's just a bit drifty at the moment. You know, we had the payrolls that came out on Friday, and then since then the market has been definitely a little bit lackluster, but still bullish. You know, don't get me wrong. This is a market. The US stock market's still very bullish. And to wrap things up, let's look at something we haven't looked at for a few weeks, and we'll take the whole Europe and the general election and all of that stuff out of the equation. Let's look at the US dollar, Canadian dollar. I think this is always an interesting market because we do see some really strong trends, and it seems to sort of obey levels quite well, that sort of stuff. But this is the dollar, Canadian dollar. Let's just go back in time a little bit. So this is back to December 2015. So this great run up, then we had a big run down. So this is dollar weakness, Canadian dollar strength, and then since May of last year, so for 12 months now, the story has been the American dollar, the US dollar, recovering. against the Canadian dollar. So we've seen the market trend higher, trend from about 125 to currently 134. So we're what, 900 points higher than we were a year ago. Great trends in place. We've got a big level, you know, for the longer term people, a big level down here from April ahead of 132. So 132 is a really big level because we've also got the trend line coming in there. We're currently about 250 points above that. But I think where it's interesting, it's coming off a trend high, so that the highest it's been since this trend started, right? Which is about a month ago. So it traded up to the 138 level. So it's coming off that. We've had this correction, and I think if we look on the hourlies, there's an argument, I think, you know, for being a buyer. So there's our correction off that high up there. So let's plonk our trend line on that. So it maybe looks something like that. So we had our correction wiggling its way lower, but since the 25th of May, it's sort of been trying to shake that downtrend off. So it did punch out to its best levels since May the 19th. It's come off a bit since then, but I think we've clearly been left with some levels to watch down here. So for me, this pullback that we're seeing now, this one, could well be a buying opportunity. You know, we've got a bit of support coming in down here where it has sort of held over the last couple of hours, so 134.28. And then after that, we've got, I think the ultimate level is down here. So I think it's interesting, you know, the market's currently 134.54 to buy. The big level is 133.80. So, you know, if you thought that we were going to see the market run all the way back up to 138, that's a 350 point move from where we are now if we bought now. So 350 point move back up to here. And if we had our stop loss the other side of 133.80, we could risk, what, I don't know, 80, 90 points. So we got maybe 90 points risk, but 350 points potential upside. So for me, that's an interesting trade. You know, in terms of risk rewards, where we're trading, you know, around about now, I think for a medium-term swing trade, it looks like a really interesting one. And the assumption is for me, that trend has been down and has broken. The market has recovered, it has slipped back, but we've got a big level left here, a big obvious level for the stop loss down here. There's not too much going on in the RSI. We've got, I suppose, a little, it's not quite textbook, but a bit of bullish divergence. The market slipped to a low, and then it slipped lower still. The RSI is making higher lows. So we've got an argument for saying this trend is running out of steam. But I just think this whole pocket of support from 33.80 through to 34.20 is an interesting one for the dollar against the Canadian dollar. So I think that could well be, to take all the election stuff out of the way, that could be one to keep an eye on. So that's it really. It's the election tomorrow, early hours of the morning. If there's any shocks, I'll be on Twitter I think anyway, but you'd expect the pound to be moving around a bit. FTSE is still strong, and we've got, you know, just below where we are now has proved to be good support in the past. And to take all of that out of the equation, dollar Canada looks like a really interesting one for the reasons we've just been through. I'll wrap things up there, but for updates on charts and stuff during the day, you can follow me on @JonesTheMarkets on Twitter. Any questions about this, drop me an email. I normally try and reply within 24 hours, but so David@tradeafter.com is my email. And to read about my adventures in social trading, I think the account is up about 5% the last 3 months. Relatively low stress way of gaining exposure to the markets. If you go to www.tradeafter.com, you can read about that. But we'll wrap it up there. We'll do it all again next week. We'll see who's in power this time next week, and we'll see what the markets look like. But thanks for coming along, and I hope you have a good trading week ahead.